Welcome to IMG Insights, our video series that dives into topics relevant to multifamily real estate investing. I'm Dave Mickelson, Director of Investor Relations, and IMG is a sponsor of investment real estate. We're always emphasizing the importance of understanding the risks and opportunities associated with apartment ownership. Of course, one opportunity of investing is the unique set of tax benefits. Looking at the after-tax returns is really the appropriate way to assess the total returns of an investment. I'm back with real estate tax expert Rick Say. In our last episode, Rick and I discussed lower rates for long-term capital gains. If you missed that, I recommend watching that one as well. In today's video, we'll dive into another tax advantage of investing in multifamily real estate. Rick, would you please talk to us about depreciation and why that's a beneficial piece of the investment?
Right. So when you hold this real estate, the cost of the real estate is written off over the time that you hold it based on what the hold periods are under the Internal Revenue Code. And that write-off is called depreciation. And that depreciation is taken on real estate over a straight line method. What that means is the cost of the property is divided up into equal parts for each of the periods. And for residential properties, that hold period is 27 and a half years. So each year you get to write off 1/27 and a half portion of the cost of that. Now, there are new items that have come in. One is called a cost segregation study, and that allows us to divide the cost of the property up between its components as to the building versus improvements or parts of the building, such as the air conditioning system or the roof or other items. And those are allowed to have a faster depreciation period than the 27 and a half year. But the depreciation is a way for you to take a deduction each year for a portion of the cost of the property, and that helps reduce your tax liability in that given year.
Very good. And the cost segregation is an approach that we've used with our investments. And it really produces some substantial depreciation in the early years, which is beneficial. Rick, another piece that's, I think, more recent is the tax code changes with the bonus depreciation. In a nutshell, talk a little bit about that one too.
Yeah, so when you have that cost segregation study and you allocate a portion of the cost into some of these other pieces, those other pieces, such as the air conditioning system or components of the building that are not specifically attached to the building, those items are allowed to be depreciated 100% cost in the year of acquisition. So that really gives us a big deduction for that depreciation in the first year of acquisition of the property. And that's just a great deduction to help reduce tax liability on these investments.
That's really good. And I don't know all the ins and outs of the bonus depreciation, but is some of that kind of being tapered down here with what the
Yeah, what's happening as we move through this, the law came in 2017, and those components that are allowed to be depreciated over a shortened period are reducing each year over beginning here in 2023 and moving through 2027, so that the accelerated depreciation that we're getting in these early years will be reduced by 20% each year for the next 5 years. And that just means that this is an item that's going to be going away the way the current law is written. So unless there's a change in the law, these bonus depreciation amounts will be reduced over the next 5 years.
Nicely done, Rick. Thank you again for sharing your expertise on this topic. This concludes our video for today, but tune into our website for more IMG Insight episodes on demand, where Rick and I will continue to explore the tax advantages in multifamily real estate investing.